Hi all, here's another recording just walking through the Wiley Plus assignment for Module 4 or Chapter 7. There are two questions here. The first one I think is pretty straightforward. I'll walk through it quickly. The second one, there's one part of it that's, I'm going to say I hate the wording of it, but I like the rest of the question, so I will go through and hopefully save you some grief. So number one is an allowance for doubtful accounts question. So basically review of what you would have done in Accounting 102 or 202. We get a bunch of information on a company. Oh, sorry about the phone. And then we just have to do a calculation of the allowance and the year-end entry and record the year-end entry. So if you go through this table, I think everything's pretty standard. It gives you the balance at the beginning of the year. It gives you the information for the bad debt expense accrual. Now, I think the only thing that might be a little confusing there, 89% of the sales were on account. They record bad debt expense at 0.8% of net credit sales. So when you go to do the bad debt expense accrual, you're going to use whatever percentage you have in your question, but make sure it's times the 80 million times 89%. It would only be on sales on account. You wouldn't take a bad debt expense on cash sales. So in this example, it's going to be 80 million of sales times 89% that were on account. That gives me my credit sales, and then I'll take the 0.08% and that'll add to my allowance. Gives me an interim total. I'm going to subtract from that everything I've written off, which number you're given. That's going to give me a balance before adjustment. And then the question also gives you what the balance should be at the end of December, and the entry you need is whatever fits in this cell, the allowance adjustment. And your journal entry is just going to be debit allowance, credit bad debt expense, or vice versa to get the allowance up to or down to the credit balance you require. So I think that one's relatively straightforward. The second one, there's just 4 different scenarios here of ways a company can use receivables to get money. The first one is normal. We will be doing sales of receivables or factoring. So in my example, we have to obtain cash factors without recourse 22,000 of receivables, and the finance charge is 10% of the amount factored. So the transaction here is I'm going to get some cash. I'm giving up receivables, right? I'm giving receivables to the company I'm listing with. And the account they use to book the difference, in this example, I'm paying 10% of the receivables as a fee. They use a loss. Loss on disposal of receivables. Personally, I'd rather see finance expense there, but either is fine. Well, no, sorry, not either is fine. Wiley's very fussy. So it is looking for this account loss on receivables. And yeah, from there, the cash is the net amount you receive. The accounts receivable is the amount you're giving up. In this example, 22,000, and then the loss is the 10%. Okay. Question part 2 is the one that I find it's not a transaction you would ever see. So I'm just going to throw it in here. It says to obtain a 1-year loan of 67,000. Sheridan assigned 77,000 of specific accounts receivable. The finance check is 6% of the loan. The cash is received. So what they're saying here is I've got a note payable of 67,000. I've got a finance expense of 6% of that, and the net is the cash I will receive. Okay, I just noticed this note's payable, obviously, well, hopefully obviously, it should be a credit. Okay, I'm just going to make sure that I got the right accounts here, because again, this is a goofy transaction. Yeah, looks like it's happy with that. Okay, so you just need to do the math on what the 6% is. Again, I'm not sure why you'd record the finance expense now. It's really over a course of time. Number 3, The company wants to maintain the allowance for doubtful account at 4% of gross accounts receivable. So all we're looking for here is we want this balance to be equal to 4% of this balance. So you need to make an entry to the allowance and to bad debt expense to make it that amount. And just watch here. They've left the allowance in a debit balance. The allowance should always be a credit balance. So the amount of the entry you're going to have to record is enough to get a credit balance equal to 4% of accounts receivable. And then part 4 is the company wishes to increase the allowance account by 1.4% of sales. And debit bad debt expense, credit allowance for 1.4% of that number. Okay, so hopefully that will help you. And yeah, the rest of it should be pretty straightforward. Thanks.